Hey everyone, me Kevin here. It's time to talk about what the Federal Reserve just said, specifically an important voting member of the Federal Reserve, about what could potentially break, which is a little bit scary. But first, in order to visualize how things can break, I want you to see how quickly things can change by using an example that we faced earlier this year. Yes, that example was an unforeseen shock, a black swan. This is where the bears wrangle their hands and go, finally, Kevin's gonna flip to the bear side. This is the inverted yield curve. The inverted yield curve, which is the green line, the zero level, anytime we cross below it, we tend to signal a recession. It's not perfect, but it usually tends to signal a recession in more cases than not. And what we find is that as the yield curve inverts, that is, this chart goes down, our economy is more fearful we might be trending into a recession. And what you'll find is that we got pretty dang low in this inverted yield curve. We got over here into this negative 100 basis points of inversion, negative 100 over here. And you had this really, really rapid shock to the upside when you look specifically right here. This was your March banking crisis. And what it shows you is you could quickly uninvert when there's a crisis, some kind of black swan that you didn't see coming, something that says to the Federal Reserve, stop hiking rates and start cutting rates. And it's usually this that signals the end of a recession, something breaking, leading to a rapid bailout of the Federal Reserve. Happened in the late 1980s, it happened in March of 2003, it happened in February of 2009, it happened in December of 2018, it happened in March of 2020. When the Fed goes, oh crap, and the Fed blinks, that's when your recession is generally over. That's usually by the Fed pivot time. The problem is, we've been so conditioned at knowing about, okay, yeah, buy when the Federal Reserve pivots, that markets have actually been pre-pricing in this Federal Reserve pivot. I've certainly been talking about it for over a year on the channel, actually coming up on 2 years, this idea of you buy when the Federal Reserve pivots. And this led me to believe that we might end up facing what I called a volatile Nike swoosh, which is where markets slowly start pricing in that the Federal Reserve will eventually pivot. And in a weird way, if you look at the week chart on the NASDAQ, on the QQQ, you've kind of started having that volatile, it's almost been unvolatile over here, this pricing in of the Federal Reserve's U-turn since January 1st, realistically here. And so now the question is, okay, well, what does the Fed actually think? Is something actually going to break? And what is going on with the yields? Why is the 10-year up about 8.7 bips today and the 2-year is flat to negative today? What's going on with oil prices and how do we make sense of all this? Because it just feels like we're setting up for inflation to renew if oil prices are this high, and that any talk of the Fed slowing down should be wrong. Well, we'll analyze that right after we listen to what the Fed just said. That is CNBC, by the way. Notice how they're talking about the ARM IPO pricing coming in way lower than expected, probably somewhere around $15 per share lower than expected. I made a video, I encourage you to watch it, just type into YouTube, Meet Kevin ARM IPO, breaking down how overpriced that offering was, and how I'm like, this is a ripoff. You should not invest in it. So obviously, I'm going to take full credit for them finally having a come to Jesus moment and lowering their price. All right, with that said, let's listen to what the Fed just said and add commentary.
Yeah, we can only hope. Andrew, joining us now in an exclusive interview is Federal Reserve Governor Christopher Waller. Governor Waller, thank you for joining us this morning. It's really a great time to have you because we had all that data last week. We had the jobs data and we had the PCE inflation data. I wonder if you've been thinking about it and how you react to what's happening. Is it going along with your forecast?
Yeah, thanks, Steve, for having me on. Yeah, that was a hell of a good week of data we got last week. And the key thing out of it is it's going to allow us to proceed carefully, as Chair Powell said at Jackson Hole. There's nothing that is saying we need to do anything imminent anytime soon, so we can just sit there, wait for the data, see if things continue. The biggest thing is just inflation. We got 2 good reports in a row. Can wait and see what a third one looks like and see whether this low inflation is a trend or it was just an outlier or a fluke.
When you say low inflation, when I looked at some of the things that we know that the chair looks at, I know you do too, which is that PCE core, taking out housing, it actually went up. What about it made you feel comfortable?
Well, the thing that really drove it were non-market services, and those things can be volatile. They're not really a clear indication what market prices are. So I typically, don't like to throw things out, but in general, this time it clearly was something that was a bit odd, and we'll see if this continues.
Meanwhile, the unemployment rate went up. Is that a source of concern for you? It was up by 0.3. Is this the beginning of a gathering weakness in the job market, do you think?
Well, the data last week clearly showed the job market is starting to soften, but the unemployment rate, if I remember correctly, last August was 3.7. So you're roughly where you were a year ago. So we're not seeing a big movement. And some of the increase was just an increase in labor force participation. As more people entered the labor market and are looking for jobs, jobs are getting a little tougher to find. It's not surprising the unemployment rate went up a couple of tenths. But again, it's really not much different than it was a year ago.
It is worth jumping in here and just comparing to what the unemployment rate has been historically. Now we know, and this is a big problem. It's a big problem for the bulls, okay? The unemployment rate is literally the last thing you should be looking at to know, are we actually having some form of black swan or crisis ahead of us? Remember, black swan or crisis is something so bad that all of the companies start going, oh, we thought we were going for a soft landing. That's really bad. Let's start seeing where we can cut. And then when all companies start going, and they start going, okay, lay off, we need to preserve, that's what a recession is. That's when all of a sudden everything hits the fan because everyone actually has true panic. That's when the layoffs come. So it's no surprise that, of course, the unemployment rate is a lagging indicator. We already know that. But he's not wrong in saying us being over here at 3.8. I mean, look, if you draw a line across this, you're between these two bars right here, right? You are very, very historically low. I mean, you've got lows over here in 1968, also sitting around 3.4 to 3.8. You look at the lows over here in 2000. Oh, the great comparison to 2000. But it shows you the pain that could happen, right? You're not even at, well, yeah, there you are, 3.8%. There you go. So, yeah, you are at a very, very low level. But again, this could rise very rapidly, and usually it doesn't rise rapidly until you're actually in a recession. So we know this is lagging, but again, it requires the shock. We need a big shock to happen. It could be a debt crisis. It could be a banking crisis. It could be nuclear war. We don't know what it is. That's why it's called a black swan. And the problem with betting that there's going to be some kind of big black swan is if there really isn't a big black swan, or something doesn't break, then you just missed out on a whole lot of returns in the equities market, potentially even the real estate market. Yeah, that's all right. By the way, we're noticing this massive lack of competition in wedge deals. It's really enjoyable right now at Househack because the people who are trying to buy, not capable. They don't know what they're doing. All right, let's keep listening. By the way, that Househack fundraise is starting soon. We're just waiting on our approval letter. Should be within, we're ready to go, so should be any day now. Here we go.
Is all of this in line with an outlook that you have for a soft landing, or do you still see a threat of a recession to the U.S. economy?
Well, the way the data is coming in, it's looking pretty good. But recessions often are caused by shocks that just come out of nowhere and hit the economy. So that can always happen. And that's why they're shocks. We can't really predict them. But the way that...
This is an interesting line, by the way. That can always happen. It is true. You could have a black swan that comes out of nowhere at any point. Of course, the economy is a little bit more sensitive at this point, where maybe it would cause more damage. But yeah, you could legit have a terrorist attack, a major war, a major catastrophe at any point. Problem is, if you're always investing, waiting for the black swan, you end up being right 1 out of 7 years, but then you miss out 6 years of those 7 years, right? That's problematic.
The data's coming in right now. It's looking pretty good that if we can keep inflation coming down for the next few months, on trend at like 0.2 a month, we're in pretty good condition.
So can you stop raising rates now, or do you still need to hike more?
Well, that depends on the data. We have to wait and see if this inflation trend is continuing. We've been burned twice before. In 2021, we saw it coming down, and then it shot up. The end of 2022, we saw it coming down. That all got revised away. So I want to be very careful about saying we've kind of done the job in inflation until we see a couple of months continuing along this trajectory before I say we're done doing anything.
It's also true. Like, you got to remember what's happening internationally, and I think it's really easy to forget what's happening internationally, because internationally could be a red flag of some things to come. Consider this for a moment. We just saw that Saudi Arabia once again voted to extend voluntary cuts of 1 million barrels per oil a day until the end of 2023. Now, this isn't OPEC, but it's a big producer of oil. And this is in addition to the 166 million barrels per day of voluntary cuts from OPEC, right? So you've got the OPEC cuts and the Saudi cuts leading oil prices to rise. Those could create an inflationary impetus. This on top of, obviously, Russia's oil cuts, which we know is just really fueling China, but then China's economy is slowing down, which is why they're cutting oil production, because they're like, well, we got less demand from China. But at the same time, consider what's happening internationally. Singapore just barely missed its recession and came in with lower estimates, revised down than expected for their economy. South Korea's inflation advanced much faster than expected. People were looking for a 2.9% acceleration. They ended up getting a 3.4% year over year. This has led the Bank of Korea to say, hey, maybe we don't need to cut anytime soon. In Europe, it somewhat feels like inflation has stalled. The annual rate of inflation accelerated in France to 5.7%, to 2.4% in Spain. Inflation in Germany, which is obviously the largest economy in Germany, was 6.4% in August, only slightly down from the previous month. Core inflation, which takes out those energy prices in Europe, did slow, but barely, from 5.5 to 5.3 in Europe. It really feels like everybody is suffering except for America at the moment, which on one hand is a little bit of a red flag that maybe we're just supposed to be like everybody else, and eventually we're going to get a bad inflation report again, and that could lead to rates going even higher, and then that leads to a banking crisis, and then that leads to the black swan. It's all charted out. It's obvious, as the Bears like to say. It's obvious, Kevin. It's right there. The problem's right there. That's entirely possible. So far, it's not what we're seeing in the data, though. And again, it's hard to argue, okay, yeah, we should absolutely be investing in the bear case because the U.S. data isn't that bad. Now, of course, there's this element of, oh, well, is it rigged? Maybe, but even if it's rigged, it's not trending that bad. It's still trending good. Even when you consider the revisions, we are trending in the way the Fed wants us to trend, with unemployment, with jobs, with inflation. Things are good. This is why Waller talks about a pause. I'm kind of giving away a little bit of the ending here, but we'll listen to the rest and we'll keep adding some commentary. But point is, America feels a little Goldilocks-ish right now. And yeah, to some extent, we should be a little cautiously optimistic around that. And I think that's the way to play this market, is kind of like, I don't know, the economy seems pretty good, but let's at least have a little bit of caution. Maybe a little bit of cash on the side to buy the dip when and if that occurs, right? Okay, let's keep listening, but keep this in mind. The rest of the world is not winning as much as America is. This does put strength on, or pressure upwards on, the U.S. dollar. Pressure upwards on the U.S. dollar can hurt earnings at American companies because it makes the dollar more expensive, which leads to less earnings in other countries. But also, when you convert other country revenues, whether it's Chinese yuan or euro or whatever, into the dollar, you end up having less money, right? An iPad sold in Germany, for example, or France, brings less net revenue to the United States when the dollar is strong. And unfortunately, because the United States feels so Goldilocks strongish, you have this strengthening of the dollar, which does put pressure on corporate earnings. So it's like, yeah, good news, kind of bad news. It's not a clear as day, yay, all in, leverage up on YOLO margin and YOLO call options, right? But it isn't so bad that we want to say, oh, we want to sit this one out completely. That was 2022. Best move would have just been sit 2022 out completely. Don't even buy the dip in 2022. But again, hindsight is 2020, right? This year doesn't feel anywhere near as bad as 2022. And if somebody is creating fear, the level at which we had in 2022, now, I think they're being disingenuous. But that's just my take. Again, I'm always looking for like a, Where's their value in what somebody's saying? For example, the other day somebody's like, Credit Suisse is doing layoffs. See, the banking crisis is coming back. Well, no, duh, they're doing layoffs. Look at what the banks just went through. Like, this is so obvious. Of course the banks are going to do layoffs. The whole banking sector is under massive pressure. The only people who are winning are, as usual in America, the rich getting richer. Jamie Dimon gets exemptions to the amount, how large JP Morgan can get to go bail out First Republic. Again, the rich get richer. And at this point, it's sad, but it feels like that's the American way, is the rich are just going to get richer here. The people who put their pants on are like, I'll go through whatever the hell happens, but I want to be invested on Train America. Those are the people who end up winning. And it's everybody who's like, I'm just going to wait for a great reset. It ain't happening. And even if there is a black swan at some point in the future, you ain't going to have money to buy it anyway. That great reset. That's the problem. That's why poor people always get screwed in America. Because when you have a disaster that happens, some kind of black swan, it's the people who have access to assets, even if those are discounted stocks or discounted real estate or whatever. The people who have the capability of borrowing because they have assets, they're the ones who end up winning and swooping up all the deals during a great reset. Of course, nobody wants to say that. Just people on YouTube just want to go, don't worry, you'll have your chance to get rich. Don't worry, there'll be a great reset. Where's the data? Keep listening.
But would you say the risks are now evenly balanced between doing too much by the Federal Reserve or doing too little?
Yeah, I'd say they are more. I don't think one more hike would necessarily throw the economy into a recession if we did feel we needed to do one. But at the same time, like I said, the job market is still pretty strong. I mean, these numbers are still near historic lows at 3.8% unemployment. So it's not obvious that we're in real danger of doing a lot of damage to the job market, even if we raise rates one more time.
It's a little bit of a warning there that they are still leaving that door open. Again, I personally think they're leaving that door open. Yes, because it's possible they may actually raise rates. That's fine. But I think they're leaving the door open, again, to mess with our expectations. If they came out today and they're like, yeah, we're done, everybody's going to go YOLO margin. You're going to have inflation come back instantly.
Chris, let's talk about the issue of monetary policy lags. This is something that some folks have said is a big deal, and it's there's yet to come a wave of negative impact on the economy from the big shocks of interest rate hikes you had. But you've had the opinion that the lags are here now, that in this economy with a big increase of interest rates, the way the Fed did it, that there is not much of a lag to the economy. And that kind of puts you a little bit at odds with Fed Chair Powell, who said recently that there could be significant lags yet to come.
Well, this is a tricky problem because there's never an exact number on when the lags tend to hit. And I think, as I gave a speech back in July, that I think the lags are shorter. They're still there, but they're not we don't have to wait 2 years for this stuff to start impacting on the economy. And we're seeing it.
That, by the way, is a way of saying, hey, we can hike rates sooner because we don't have to be so worried about the lags. That's a little bit more hawkish. Again, I think messing with our expectations, mostly because look at the betting market right now. 96% chance of a pause September 20th. They've massaged the messaging perfectly. And they're basically leaving November, December at a coin toss for one rate hike. You have a 42% chance, well, it's less than the coin toss, 42% chance for November, 38% chance for December. It would be either one of those since we'd level out at 5.5. And then 52% chance, only 31% chance that we're at 5.5 in January. And only a 20% chance that we're at 5.5 in March. Now, obviously, these numbers could change very rapidly, but it's pretty clear that markets are actually starting to price in the first cut, it looks like, depending on if we get this last hike or not, by May. But anyway, point is, what's really interesting is one of the reasons you're seeing so much money flow into, or in my opinion, one of the reasons you're seeing selling on the 10-year, because the 10-year right now is up 8 basis points. You can see that right here. I think one of the reasons you're seeing this is because why would you go for 4.25 on a 10-year if you can have pure liquidity and no market risk in the money markets? And I find this very incredible that money markets have actually seen these recent inflows. Now, you do tend to get these drop-offs. Usually you get these drop-offs as the Federal Reserve does their $80 billion of tightening per month. But this slow and steady hiking over here of the repo balance, it's a way of saying people are just going into money markets, which, think about it. Why would you be taking 4.25 right now if you think that you can, well, you could just get 5.5% basically overnight on money market funds? Well, that's at least what the banks are getting. You might be getting 4.9 or 5%. It totally makes sense to just sit in money markets. The only reason you buy the 10-year is if you think, okay, rates are going to plummet, and then you could actually make a capital gain on this, right? I actually think that's a potential move where you start buying the dip basically on these 10-year treasuries, because when the Federal Reserve finally cuts, guess what's going to happen? It's going to happen really, really rapidly. As soon as the Federal Reserve cuts rates, the money market funds become less desirable because your money market's going to go from 5% to, say, 3% really, really quickly. Well, then people are going to start buying up the 10-year because they're going to be like, oh, I want to get those higher yields. But when they buy them up, all of a sudden those yields are going to disappear. Anybody who owns bonds going into that is going to get juicily rewarded on owning bonds. So there is some argument for actually having a bond fund or just straight bonds in your portfolio going into Fed cutting. Definitely a strong argument here. So keep that in mind. Yeah, I'm not generally the biggest bond buff, but right now I'm actually like, I don't know, man, they're looking pretty juicy, okay?
Now, as far as I'm concerned, you're starting to see the economy slow down. We're seeing inflation coming down, and it's really been just a little over a year that we've done a lot of large hikes. So I think we're already seeing the impact. The other thing that people seem to have this idea that long and variable lags means there's this cliff effect, what I call the Wile E. Coyote moment, where the economy's going long and then it just collapses. That's not how these typical lags.
Yeah.
They start having an effect, they build up, and then they eventually fade away. There's none of this cliff effect that everybody keeps talking about.
I think that's such a great line right there, this idea of the cliff effect. There's so many people right now making these bear pieces on, oh, we're going to hit this cliff as soon as people have to start repaying their student loans. Remember, Biden already softened the student loan cliff. He already softened it by saying you don't actually have to make your payment. Interest will accrue, but just make your payment when you can, and you don't actually get dinged, ding-dong-dinged, for about a year. When we actually start punishing people who don't make their repayments. That means you could slowly ramp on. Somewhere around 50% of people don't actually expect they're going to start making payments as soon as repayments are due now. And so that means you're going to have this half of people with student loans who are just going to slowly make their payments over time or start repaying over time. There's no cliff. So that's why at least the black swans that people are talking about now, I'm like, really? Where? Again, it can come out of nowhere. That's why they call it a black swan. But again, is that a reason to say, realistically, every single year, forever, you could be like, there's going to be a black swan coming. And this is why you usually have the bear fudders who are usually, it's like, it's 2012. Oh, there's going to be a double dip recession, a shadow inventory of foreclosures. 2013, it's, the Eurozone sovereign debt crisis. 2014, here comes the Eurozone crisis. It's going to collapse the whole world. And it is like, 2015, we're getting rid of QE, or that's it. Our economy's built up on cheap money. It's all going to implode. And then you look at the past 10 years, before COVID, it's just like, how could you not have been investing? Who cares about the nonsense inventory? Anyway, my take. Thank you so much for watching. Make sure to go to househack.com. Drop your information there to be alerted when we're finally ready to go live on househack.com. Appreciate y'all. We'll see you in the next one. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.